Hi, welcome to the Market Alert for January the 31st, 2017, so the last day of January. Tomorrow we'll see the FOMC meeting minutes at 7 p.m, but more on that going forward. So yesterday the market, let's just go back to the pre-market session. You can see that the market was sideways, flirted with the 20,050 level there. You can see that, or the blue line, before then moving lower. I'm just going to remove the purple line because that was the all-time high before we broke the 20,000, and we've got the the orange line here, which was the 76% we had in a few weeks ago, so we'll remove that as well. So yesterday afternoon I sent a note out saying we got the short we've been looking for. Everything had come together. We got the lows in the implied volatility, the Trump euphoria over, and just a case of breaking back below the 20,000, which I mentioned in yesterday's market. If we take this out, then we're going to go lower, and that's precisely what happened. So then we saw the market break the 20,000, go down to the scalp. Prices are below the 20 bar moving average as well. We're looking for the short side, as we have been for many days, so it's a clue there that we can actually trail, as the market is likely to continue to move lower because of the backdrop of all of the information. Again, I'm going to go through that again as we go through this market alert. So once the market hits the scalp, we can remove the scalp and we can move the stop loss to break even, and then we can use the 50% to just keep marking up on the lower highs. And as the market keeps making each lower high, we can then just keep moving in with 50%, and you will see eventually we get down to the 19,000 level where the trade is actually taken out, giving a profit of just 79 points on this trade. The market then moved back, tried to find some support, and you can see that it struggled for a while. We're going into a quieter part of the session. We know the short side is going to be the better side, so you can see here, if you'd taken this trade, we've got a situation where the market comes back and eventually comes back. It doesn't take it out there, it took it out over here at 22 points, and then you had the chance to recoup as the market then moved back, as you see there, up to the 19,050 area. So certainly an interesting pattern developing here in the daily charts. Let's have a look at the bigger picture so we can get a good idea. Now yesterday I didn't notice this until it was brought to my attention. I thought it looked odd at the time, but I actually drew in the Fibonacci yesterday of this high down to the low, the low that was in the pre-market session, and it didn't quite work right. And the reason is that the software doesn't allow, when I spoke to the programmer, it doesn't allow for you drawing Fibonacci's on real-time bars. So for example, if I click on this bar, I can only go to the low of yesterday's bar. It won't allow me to go over to today's overnight session. So now we've got this low in place at the moment, unless the overnight takes it out. I can draw in here, and any rally to the upside now, these two figures here, unless a new low is shown today. Let me just draw this in, let me make it a bit easier for you. So if this price 19,868 is taken out today, then we will redraw the fibs. But if it stays intact and the market moves back to the upside, watch these two areas, the 20,036 and 20,074. Also keep in mind that the 20,000 is a major psychological level once again. So make a note of these figures, keep an eye on the 20,000. If you get a buy signal to the upside, watch the 20,000 level, because it's going to take a lot of momentum to drive the market through that sort of level, given the backdrop now. News-wise, we've got Draghi speaking today at 8 a.m. in the pre-market, and all we've got at 3 o'clock is the consumer confidence out in the US, and that's showing a bit of a drop there as well. In the bigger picture, well, it's happened, and I'm going to go straight to the monthly chart because I covered this in Sunday's or Monday's market alert, the first one that I recorded, when we looked at the volume for December, given that it is a holiday month as well. But it was ideal for the pros to offload, as we've had confirmation, Goldman Sachs, JP Morgan, etc. We had 5,231 shares traded there, and you can see the range of January's bar is far less in range, and the volume now is 200,000 greater. So we definitely have some upside pressure and selling in this market without a doubt. This is now confirmed as well, even just looking at the monthly chart. The volume's increased significantly. The big boys are getting out. We know that. We've had confirmation. It's been reported officially and also reported on Zero Hedge as well. So keep an eye on this as well. I'll report on this each day. Implied volatility obviously jumping up from 8.15 low on the 27th of January to 9.84. That's exactly what you'd expect. And a question I was asked yesterday is, how do you know when the bottom is going to be in place? For example, in this daily chart, how do we know how far down the market's going to go? Well, we don't know that. We know that we've got physical areas of support here down at 19,719 plus. We also have a low here as well. And that's fine. We can use these visuals to assist. Certainly great in taking profits and being aware that the market could find support. But one, or the best way to find the bottom in a market, again, is to use the implied volatility. And I've just put this chart in here for you. This is a 1 year chart, so you can see what happened over the last year in picking the market bottoms. We had a low of 13.35 here, all the way up to 24.95 when the bottom was in place here. Look for 80 to 100% increase in implied volatility. That will give you an indication of the market putting in a low. 10.54 here, the market pulls back for Brexit. 18.75, 80% increase. 8.91 to 14.15, again 90%, 80%. The market then traded sideways, the market was held. We then had another low here in implied volatility, 10.51 to 18 point, and then 18.19, and we see the market moving high. So we're looking for the implied volatility to go around 15 to 16 before we find a sort of base or bottom in this current pullback. That's what we're looking for. It doesn't mean to say that the market will hold at that level either, because if the market turns to bearish, there is a way of measuring again the retracements in the implied volatility to confirm whether the market's going to go lower again. And we would have had this over here as well. You can see you've got a pullback in implied volatility. It again, we're looking for if it doesn't break 50%, then we'll get another move to the downside, which is what we got here. Again, something I worked out way back in 1994. But now I've created my own charts, I can actually show you this, and we can look at this as it unfolds. And finally, news-wise, well, as I spoke to you about this before, is Trump about to hammer the Federal Reserve? I'm not going to read the articles, just to show you that there's a lot going on at the moment. Trump slump begins, Dow loses 20k as stocks suffer, biggest drop of 27. Great clip here from Animal House, all is well. And that's about right given the current climate, what with all of the civil unrest as well. It seems to be taking on a life form of its own as well. February FOMC meeting, a powder keg in search of a match. Yes, definitely, because unlike most times when you get to the market minutes, this time it's going to be slightly different, because the minutes are going to reveal about last month's, well, December's increase in interest rates and the methodology and reasoning behind why they actually decided to increase rates. So that could be a powder keg as well, because it will be setting a bit of a precedent as well. So it'll be interesting to see how that pans out, and that's tomorrow. So expect the market to be fairly sideways and quiet unless something else comes out. Also, I haven't got the article here, but it appears, let me see if I can just find it. There you go, I found it. ECB assets rise above 36% of the Eurozone GDP. Draghi now owns 10.2% of corporate bonds. This is just insane. People are worried about Brexit, and the Eurozone is imploding by itself. You don't have to worry about whether you're going to get a Brexiter or any other European country leaving, whether it's the Italians or the French or whatever, because it's destroying itself internally with the debt. And this is what I keep saying to people: forget politics, look at the numbers, see what's really going on. So you can see the ECB's balance sheet rose above 3.72 trillion, equal to over 36% of the entire Eurozone GDP It means that Draghi now owns over 10% of the entire European corporate bonds. I mean, this is just insane that the ECB should own corporate debt to keep these companies going. It is insanity of the first order. Anyway, on that cheery note, I will see you in tomorrow's Market Alert. As ever, thanks for watching. Also, the questions and the feedback, very much appreciated. I shall see you in the next one. Thanks for watching.